Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Performance Food Group Company quarterly report. Performance Food Group Company offers a wide range of businesses and services to its customers across North America. The company's primary focus is on the marketing and distribution of food and food-related products through its three main segments: food service, convenience, and specialty. The food service segment caters to individual restaurants, national and regional chain restaurants, and theaters by providing a variety of products such as beef, pork, poultry, seafood, frozen foods, refrigerated products, dry groceries, candy, snacks, beverages, fresh produce, dairy products, bread, general merchandise, health and beauty care products, and cigarettes. The convenience segment serves national, regional, and independent convenience stores with similar product offerings. In addition to product distribution, the company provides value-added services including marketing programs, technology solutions, product selection and procurement, menu development, and operational strategy. These services are designed to support customers in optimizing their operations and improving customer satisfaction. The company operates a network of distribution centers across North America, enabling it to efficiently deliver products to its customers. With over 135 years of experience, Performance Food Group Company has established itself as a leading provider of food and food-related products and services in the region. Unfortunately, I do not have access to the text you provided. However, I can still provide a general essay on what might cause a company's stock price to remain stagnant over a period of time. The performance of a publicly traded company is often reflected in its stock price. A stable or stagnant stock price can be attributed to various factors. One possible reason is a lack of significant growth or innovation within the company, failing to impress investors and analysts. This could be due to internal issues such as poor management decisions, inefficient operations, or an inability to adapt to changing market conditions. Another factor contributing to a stagnant stock price is external market pressures. Economic downturns, industry-wide trends, or shifts in consumer behavior can all impact a company's performance and stock value. If the company fails to adjust its strategies accordingly, it may struggle to keep pace with competitors, leading to a lack of growth and stability in its stock price. Additionally, regulatory issues, legal disputes, or negative publicity can also negatively affect a company's stock price. These external factors can erode investor confidence, causing them to reassess their investment decisions and potentially leading to a decline in the company's stock value. In conclusion, a stagnant stock price can be caused by a combination of internal and external factors. Companies must continually adapt and innovate to stay ahead of the competition and maintain investor confidence. Performance Food Group Company market capitalization of $14 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Performance Food Group Company holds a significant advantage in their industry. Performance Food Group Company trades at a higher price-to-earnings ratio of 40 times and a higher price-to-book ratio of 2.97 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 75% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified from the extracted summaries. On the growth side, several factors contribute to increased revenue. Sales growth in the food service segment is a significant driver, as well as Cheney Brothers acquisition and net sales increase by $2.47 billion. Additionally, favorable shifts in mix of cases sold, increase in selling price per case due to inflation, and addition of new chain customers also contribute to revenue growth. On the decline side, several factors are responsible for decreased revenue. Decrease in sales to certain large customers and negative impact of inflation on food costs are significant drivers of revenue decline. Reduced demand for our products related to unfavorable macroeconomic conditions and tariffs and global trade policies also contribute to revenue decline. It is worth noting that convenience segment growth and specialty segment growth have no specific drivers mentioned, indicating a neutral effect on revenue. Overall, the primary drivers of revenue growth or decline are largely influenced by sales growth in key segments, acquisition, net sales increase, and external factors such as inflation and macroeconomic conditions. The company's net income has shown a significant increase over the past year. In Q3 2025, net income reached $61.7 million, a notable rise from $42.4 million in Q3 2024. This upward trend is also reflected in the year-to-date YTD figures, with net income increasing to $155.3 million in YTD 2025 compared to $150.4 million in YTD 2024. Profit margins have also improved, with gross profit margin rising to 12% in Q3 2025 from 11.7% in Q3 2024. Similarly, operating profit margin has increased to 1.2% in Q3 2025 from 1% in Q3 2024. The reasons behind this change in net income and profit margins are not explicitly stated, but can be inferred from various factors such as changes in revenue, expenses, and adjusted EBITDA. Despite the lack of explicit data on these factors, it is clear that the company has experienced a positive shift in its financial performance over the past year. The company's financial performance indicates a positive trend in its operating cash flow. The data shows that the net cash provided by operating activities has increased from $379 million in 2024 to $456 million in 2025, and is expected to remain at this level in 2026. This increase suggests that the company's operations are generating sufficient cash to meet its financial obligations, indicating a strong foundation for future growth. The company's debt level has shown mixed results over the given period. While long-term debt decreased by $114.8 million from June 2025 to December 2025, total debt excluding current installments increased by $114.7 million during the same time frame. Additionally, ABL facility net repayments increased by $118 million. These fluctuations suggest that the company's debt level has not changed significantly overall. The interest expenses have also shown some variation. Interest expense increased by 4.3% from $100.2 million to $104.5 million over a specific period. However, when looking at a longer time frame, such as 6 months, interest expense rose by 25.1%. This increase is significant and indicates that the company's interest expenses have changed substantially in some periods. Management's outlook for the company is cautious due to uncertainty surrounding its growth and innovation strategy. The anticipated results of this strategy may not be achieved, and sales volume heavily relies on declining tobacco products. Additionally, there are concerns regarding the integration of artificial intelligence into processes. The company faces external pressures from larger players in the industry, but its scale allows it to invest in performance brands and drive supply chain efficiencies. To stay competitive, management is focusing on independent sales and performance brands, pursuing new customers, expanding geographies, and making strategic acquisitions. The Cheney Brothers acquisition also poses uncertainty regarding expected synergies. Management acknowledges that the company's future success depends on executing these strategies effectively, particularly in a market dominated by larger players. There are indeed concerns about inventory buildup and supply chain disruption. The data suggests that inventory levels have increased significantly, particularly in the convenience segment, which saw an increase of $380.2 million from December 28, 2024 to December 27, 2025. This rise is attributed to advanced purchases, indicating a potential overstocking issue. However, it's worth noting that not all pages point to inventory buildup. Page 38 mentions a decrease in inventory due to sales in the normal course of business, which seems inconsistent with the concerns raised elsewhere. Nevertheless, the overall trend suggests that there may be issues related to inventory management and supply chain efficiency. That concludes the financial summary for Performance Food Group Company. Feel free to comment below, and I will be happy to answer them when possible.